In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good morning once again, options traders. And Stu, it's that time again. Coach's Corner.
Yeah, this is going to air in the afternoon.
Yeah, kind of seems to roll around about once a week, doesn't it?
Yeah, it does.
But it seems like it's every other day, though.
Yeah.
But we have got a very cool presentation. I think they're all very cool. But we get most of our ideas from you, the audience.
From you, we do. From the chat rooms, from the traders,
chat
from the coaching
rooms,
session.
watching YouTube, email solicitations, and we hear all of the nonsense and things that traders fall into.
Yeah, we don't make this up. Do we make this up, Bill?
No, we just report it.
We are reporters. That's exactly what we are.
So anyway, what we want to report to you today is another big illusion that traders fall into. And our question here, our little chalk talk question, if you sell a covered call, did you generate income? You hear this one a lot. This is usually how it's sold, isn't it? It's an income.
Hear it every day. Yeah, it's a marketing campaign. That's right.
It's a marketing thing.
Sell puts, generate income. Sell calls, generate income. I generated $5,000 selling calls.
Quit your job and just sell options and collect.
Just sell options, yeah.
Now, I feel like this is going to become a theme or a mantra of ours going forward, because we had some people in the chat saying, well, you know, Bill and Stu last time said that leaps are bad. We never said that. In fact, we said the opposite in the presentation. So we're going to do it again right here. We're going to get it out up front to make sure that nobody misinterprets this.
We're going to do it every time.
I think we need to.
Yeah.
We're going to be talking about short options, calls and puts. We are not saying they are bad. We're not saying they're good. We're not saying they're neutral. We're just saying it is a strategy. Here's what it does. Here's what it doesn't do. And then it's up to you to figure out if it helps you reach your goals, because that's what options are. They're tools. So we're not here to pass judgment on whether you should be doing it. Those are different conversations. But we just want to show the misperceptions that traders fall into with this and why it can be so dangerous. So let's go ahead and take a look at this. So what's our title for today? As you've probably guessed, it's on short options, getting paid to worry later. It's kind of a good way to put it when you really understand what it's all about. So let's start off from the beginning here, Stu, with the definition of income, because I think this is where a lot of the problems arise in the misinterpretations.
Absolutely.
So income, there's not really a formal definition, at least that I've heard of. You hear income definitions, accounting, you hear economics definitions, but they all have kind of a similar overlap. So income is an increase in wealth that is earned and is not offset by a corresponding obligation. All right, so that's one way to think about it. From accounting standpoint, which is what you know, right? I think that's what your degree was in, right?
Yeah, accounting. Yep.
Yep. So accounting standards would look at something like inflows that increase your equity or your wealth, but they also say after associated costs and obligations. So this is where it can get a little muddy. People say, well, if I sell the call and it expires worthless, yes, you've met your obligation. But it was a liability in the meantime. So both of them share this idea that it is some way to increase your wealth or increase your equity, but that there's not some type of corresponding obligation. And
Bill,
that's
you know what I get a lot too?
what's that?
Hey Stu, I sold these calls in my account. Where's the money? How come I can't take
Oh
it?
yeah. I think we did a coach's corner on that.
We
Where's
did.
the money? Yeah. That's another one why you have to understand the mechanics. You're not going to actually see it until expiration. That's when the option goes to zero.
Well,
Or
yeah.
the extrinsic value goes to zero. Right.
You're not going to realize it
You're
according
not
to
going to
accounting
realize it.
standards. You won't realize
That is correct.
it's just kind of sitting there in limbo. And the thing is, it's like the money that you're selling, it has a value, right? People don't really see that, right? It has a value of whatever you sell it at when you sell it,
That's right.
but the value of that money changes, right? That's
Right.
just P&L. That's the mark to market going up and down.
Yep.
And until that obligation goes away, I wouldn't dare call it income.
Oh no.
I know a lot of
Very
people would, but it's
very good
incorrect.
point. So if you receive money and accept an obligation, your position hasn't improved, at least not yet. That's the hinge point right there. Because you're accepting an obligation. Traders see, oh, I received money. That is true, but never overlook the fact that you've accepted an obligation. So when you sell these options, your balance sheet has changed shape, kind of changed the distribution, but it hasn't necessarily grown. Why? Because of that word right there, yet. You
Yeah,
don't know
yeah.
yet.
Can that obligation uh can that obligation affect your future earnings?
Oh yeah. That's
Your future P&L, your future dollars that you have available.
that's the catch.
You
That's
know,
exactly it.
and that's what people aren't really thinking about,
That's what,
right?
exactly right.
You are there could be some huge opportunity costs involved,
Yep.
which people rarely look at as well because they say, "Oh, well, I made money." Yeah, but how about the 10,000 that you didn't make
That
had
you
you
left on
not
the
had
table.
that? You got to talk about those things.
Right. Right. So income, another way to think of it is that it's payment for something already delivered. Right. This is mostly how it works. You work, whatever you bill or whatever you get paid is for what? Last month or the last 2 weeks. So you do the work first, then you get paid. Now, I'm not going to get into, you could make an argument for saying, well, what if it's prepaid? But that's also for something that we know is going to take place. It's still, that's an income deal. There's not really an obligation
That's not what we're
associated with
talking
it.
about here. Okay.
Exactly. We're not talking about that. So income is, for the most part, payment that you've received for something already delivered. Now, what about a premium, which is the term
Ah,
that they use in the options market, right?
yeah,
The premium. It's money that you receive that has an attached condition that contains risk. It's a conditional type of arrangement, and this is the part that people overlook. They see the
So,
money
Bill,
coming in.
where did you pull that specific definition from?
This one,
Yeah,
it's just one that's usually used in economics. A premium from like insurance
yeah. Well, this whole business kind of came from the
came from
insurance.
the insurance. Where that's why they use the word premium. Yep.
Mhm.
Yep. But the key words here is that you've got some kind of condition, meaning it depends on something in the world of options if the stock goes through the strike. And because we don't know that, and it could have adverse effects to us, there's risk. Okay, so in summary, income is what you keep after the job is done, premium is what you're paid before the job even begins. All right, so again, it's not income, and we're not saying it's bad, we're just saying it's not income. So now that we understand these definitions of income and premium, what are we doing with options? Well, let's go
Bill, should
back
we
to
petition the SIBO to change? No, not the SIBO. Should we petition XYZ marketing options selling coursework company to change their language to premium generation instead of
Premium,
income
premium.
generation.
Well, that would be, but that's actually a good way to, if you at least make that shift, that you're generating premium, you'll at
Yeah,
least say, well,
I'm being
what's
stupid. It's in your head, people, right? You got to
right,
think of it that way. That's what it
right.
is.
You're,
Don't
if
think
you
of
want
it
to say
like
you're
something
generating
else.
premium, then can make you pause and say, what's a premium? Well, it's a conditional payment for risk. So what is it when you're selling options? Well, let's go back to our rights and obligations, right? So
Ah,
for a
there you go.
buyer of a call, you have a right to buy. If you buy a put, what do we get? Right to sell. So for all the new people out there, a lot of times they struggle with the sell side or the short side. Start here and then flip
Everybody
it.
knows that first one.
Yeah, everybody knows the first one.
That's all you got
And
to know.
now just flip it.
Yeah,
What's the opposite of right?
obligation.
Obligation. Opposite of buy is sell. So the seller is an obligation to sell.
The
So
other
we
side
could
of the
see
trade.
that opposite and opposite.
Hmm.
And then over time, you'll just say, call seller, obligation to sell. But in the short run, you might need to start on the long side and flip it. What about for the put seller? That's the obligation to buy. How did we get that? We start with the put buyer. We know the opposite of right is obligation, opposite of sell is buy. So a put seller has the obligation to buy. But what word do you see is common to both of the sellers right there, Stu?
Well, two, TO,
Uh, but besides that one, exactly.
obligation. Here's a little
Obligation.
option hack for everybody. It often helps. I really stress this in our Q&As and in the sessions. It
Mhm.
often helps to think of yourself as not being on the side that you're on, but think of yourself as
Flip it.
on the other side.
Yep. So
And it opens up
great.
a whole new world to you.
Yes, it does. Absolutely. So let's start with a short put. This is usually the one when people talk about generating income because I don't even have to own anything, right? I'll just go out and sell these puts. So a short put looks like this.
And if I get 1%, that's a good deal, right, Bill?
Exactly. um,
Okay.
if we have this black line here, this is our expiration graph. But today, let's say with 30 days to expiration, it's this blue. And over time, we know that that blue line slowly starts working its way towards the black.
Assuming the stock is unchanged.
Well, either way, even if
Well,
the
or
stock is
down
not
to the strike. I mean, the extrinsic value will go away,
right, no
right?
matter where the stock is, you're moving towards the black line.
Well, you are moving towards the back line, but the rate of change is what I'm talking
Oh,
about.
it's a whole different story.
For that blue line to move
Right,
has to do with the delta as well.
correct. But
Yeah.
right now, I just want people to see that this blue line moves towards the black. So based on our definition, where we said there's where the kind of an income or a accounting definition was revenues after associated costs and obligations. So here you could say at expiration, we've met our obligation, let's say for 30 days. Now, if you want to call it income, that's fine. But this is what you were talking about, whether it's realized or not. See, that's the distinction. As soon as you hit sell, I wouldn't be calling that income. That's a premium. And why? Where's your risk? Picture tells it all right there.
I'm thinking back to my days on the floor when we used to get a packet, a giant thing of sheets every morning, all the
Oh yeah.
positions, everything that you can think of. And two of the columns were realized P&L
Interesting.
and unrealized
Unrealized. Yep.
P&L.
Yep.
Yeah.
Very good.
Open
So
positions.
professional traders know what to watch.
Yeah.
So again, now here's where people also make mistakes. And they'll say, all right, I get this, and I understand that there's downside risk, but I'm a step ahead of you because I know the bell curve. Stocks move roughly according to a bell curve. At least the the logs do. Subtle point, but basically they're moving like a bell curve. We know that 68% of the time you're going to land here in this blue area, one standard deviation, 95% of the time in the blue plus gray, and only 2.5% of the time in this red tail, and 2.5% of the time in this red tail. Right? If that's 95, then this has to be 100. So each of these are half or 2.5%. So
Which
traders
also
go,
means 13 and a half in the gray area.
13 and a half in the gray area.
Right. So don't
So
don't get people don't get confused with, well, what's the probability of occurrence in a two standard deviation? It's not 95%. It's what's in that second standard deviation, which would be
correct.
13 and a half.
That would be the additional. The marginal would be 13
Right.
and a half.
Marginal, yeah.
So at any rate, the point is that this tail over here is they're saying, well, this doesn't happen very often. And so, yes, I'm not getting a very big premium because it's now the money put. But hey, I'm hardly ever going to lose. So I'm going to call it income. I'm going to just keep hitting that sell button. And what's the next thing they do, Stu? Yeah, I can't
Sell
make a
more.
lot with one contract. One contract. Let me sell 20 to
I
20
gotta
of
pay for my Tesla. Dude, why don't you put a bubble like on the top of the red area that says pick up free money here?
Yeah, that's exactly how people think of it because they say this is rarely going to happen. Okay, we'll give you that. No argument. You're just defining the bell curve. You're telling me that this is 2.5% of the area, and by definition, that's not going to happen a lot. No kidding.
That's right.
What's the part that they're missing?
What
We've
you're
talked
getting
about
paid.
this before.
Well, yeah. I mean, it has to be assumed that the market is creating a fair value number, and
Correct.
that's what that number is. I mean,
Right.
somebody's willing to buy it, somebody's willing to sell it, so you kind of have to assume that, hey, why should I be any different, thinking that, well, it's too high or too low? It doesn't work like that, right? It's a
Right.
distribution curve, and the farther you go out, the less money you're going to get paid because it has a lower probability. Like, no kidding.
Right. So let's
But it
say that
doesn't
you
go away, right? The cat on the tank. It does not go away, everyone.
correct. So if you have a 90% chance of collecting, let's say, this 50-cent premium, okay, we'll give you that. And we hear this a lot, don't we? We've heard traders say, oh,
Yeah.
well, hey, if you do this strategy, you'll win 80% of the time or
80% of the time, you're
85%
going
of
to
the
win.
time. And,
Sign up here.
and we're going, okay, continue. And they never do. They just end with this sentence. We're like, that is a huge risk. It's a huge red flag.
That's a danger.
Because if there's a 90% chance of something happening, what does that tell you? There's a
There has to be
10%
a
chance
10% chance.
for it to not happen.
That's right.
And then what we're saying is, well, what happens in the 10% of the time? This is the part they forget. And
Right.
what we're arguing here is that we would expect it to be about $4.50. Why? Because 90% of 50 cents is 45 cents. 10% of 450 is 45 cents. Negative 450 because that would be your loss. And if we combine them, add them up, get zero. So this is what it means when we say that in the markets that the expected value is forced towards zero. It does not mean it's exactly zero, or on any given trade, sure, there can be discrepancies, but your expectation should be zero. Why? Well, if you're pounding the table about, I've got a 90% chance of winning 50 cents and I'm on the winning side, how smart am I? Look how great this strategy is. It's only great if you can sell it. Why would this person go, yeah, I know I'm on the losing side and I'm a total loser and I'm just here to give you money, so yeah, I'll sell it to you? Of course not. Don't kid yourself. They see the same chart and the same probabilities and everything else that you're looking at. So they will do it if this is the reward. Now, they also know it's not very probable, right? That's why they have a very high potential reward. But again, don't kid yourself into just looking at this side of the equation and thinking that this must also be 50 cents. It's not. It's much bigger because otherwise nobody's going to take the other side. We talked about this recently in some of our Q&As that price is actually the point of disagreement. And the reason we say that is a buyer and seller come together for a price, let's say to buy and sell at 50 cents. But what are they disagreeing on? The value. The buyer thinks that the value is too low. The seller thinks it's too high. It's a point of disagreement. So again, like Stu was just talking about, flip to the other side. Don't just look at, hey, here's all the benefits. Why would somebody be taking the other side? Yes, I think this price is too high, but somebody else is thinking it's too low. And you need to respect that.
And look, it doesn't really matter why somebody might be doing it.
Doesn't
Like,
matter.
everybody's got their own reasons.
Yep.
But the fact of the matter is that there is another side,
That there is another side.
and somebody is not willing to just give money away
Yep.
uh, in this area. I mean, they might be engaged in philanthropy, but this is not supposed to be philanthropy, right?
Right.
I mean,
So,
so
so
there
just
there is a
for,
value to the equation going on here.
right. So just because you might be pounding the table about what a wonderful deal this is, that 90% of the time that you're going to be winning 50 cents. And how could anybody possibly sell it this cheap? Understand that somebody's pounding the table going, why in the world would somebody pay 50 or sell that for 50 cents? See, that's why they're willing to be the buyer. And so if you make that mental shift, you'll start to realize maybe it's not such a layup. And it can't be in the long run. Otherwise, what would happen? More people sell, price comes down until this eventually balances again. All right, so that's the thing you have to understand. There is absolutely risk no matter what the probabilities are. So let's take a look at some other aspects of this. Before we do, quick reminder, marketrebellion.com/get started. More articles, videos on topics just like this to help you get started with options. So let's look at naked puts. Let's say a stock is at 100 and you sell the $95 put and you collect $2. Well, your max gain is 2. Whenever you sell an option, that's the most you can make from that option. Break even would be what? 93. We could afford to have the stock fall by the premium below this price. And so our break even's at a price of 93. But here's where traders go, well, that's okay. I get paid to buy the shares at a favorable price. This is the other illusion that we hear. That's not true. It's a misperception because you're looking at your 95 purchase price, possible, relative to the current price of 100. Well, no argument. 95 is less than 100. Yes, we see that. But what are they missing? You're not going to buy this if the stock is above 95. You're not going to get assigned with the stock at 100. If you could, no argument, you're getting paid to buy it at a favorable price. But Stu, how much sense would that make? The stock's at 100, I just sold this 95 for 2, and not only that, somebody assigned me and I got to buy the stock at 95, and I turned right around and sold it for 100.
So, like,
Not gonna
if that
happen.
happens, somebody made a giant mistake. You'd be the
Giant mistake.
beneficiary. But look, that's not. You can't count on that. That's not really going to happen.
Right. Here's the way to look at the naked put and why it's not income. So you're not paid to buy a stock at a favorable price, which is the typical wording from most traders. So let's say our stock is 100.
Here's where your obligation thing comes in, everyone.
Right. And you sell this 95 put thinking, oh, there's only a 2% chance or a 5% chance, whatever the number
Whatever.
is.
Hmm?
And I'm fine with that because if I pay 95, I'm getting stock worth 100. Nope, that is wrong because you're not
And I
going
want
to
to buy it anyway. So what's the
going to
difference?
buy it anyway. You're only going to get assigned down here. Now, it is possible, yes, at 95 or maybe a couple pennies above, but for the most part, the stock is not going to stop at exactly 95. It's probably going to be, it might be 80. Now, when you're paying 95 for stock that's being quoted at 80, are you still going to see that you paid a favorable price for it?
Dude, it's such a
I
cop
doubt it.
out. When the stock's trading at 80 or 85 or even 90, you hear, well, I wanted to buy it anyway.
I wanted to buy it
It's
anyway.
just an excuse.
It's an
It's a
excuse.
cop out. They're not realizing what their obligation was. They didn't understand the game.
That's
Right? Who would
exactly
pay 95 if you could pay 90? Come on. You
right.
had an obligation and now you have to meet your obligation. And you got paid for your obligation.
That's what you got paid for. That's the point we're trying to make. You got that premium for this setup right here.
Right. You're
You
getting
might have
paid
to,
to buy the stock at an unfavorable price. Like Bill said,
correct. That's the catch.
that's what's going on here, right? And it's again, I'm going to say it
Nothing wrong
again.
with it.
There's nothing wrong with it. Nothing wrong with it at all. People do it all the time.
Yep.
I mean, I did it, thousands of times on the floor of the exchange.
We got hit a couple of times in ICF.
We did. We absolutely did.
Yep. And we took the stock and
we get it. We
we
understand
understood the
that
deal.
we were, if it goes down, we're going to get assigned. And in fact, we put a disclaimer in it.
Yes, don't do it unless you're willing to take the stock.
Unless you're willing to take the shares. And we understand that that's the risk that we're taking for the premium,
Right.
not income. For the premium that we're receiving.
Yep.
Right. And it doesn't have anything to do with like, oh, I'm going to generate income or I'm going to do this nonsense. And oh, if I get 1% or 2% or blah, blah, blah.
That's free
It's
money. I
all
call it.
priced in.
Yep.
It's
I call it.
all priced in. You know, that thing about that you said it before about, well, let me go to Tesla because that's a volatile stock and I can get some real dollars for that. Well, no kidding. Why are you getting the real dollars?
Because
Because
you
it's
got
a
a much
volatile
higher
stock.
chance of getting hit.
You have a bigger chance of getting hit. And the price is kind of trying to neutralize
That's right.
that probability, and that's where the buyers and sellers come together.
Correct. So the thing here to see is that you get paid to buy shares at an unfavorable price. And if you can clear that hurdle mentally and say, yes, I'd be willing to do it, and you understand it's not income, it's a premium for accepting that risk, no problem. No argument with it whatsoever.
Go for it, and define your try your very best to define your risk.
Right.
Which is another topic which I probably shouldn't go into right now. But there's always some baby put underneath that you could buy to
do a spread.
quantify the dollars that if the you know what hits the fan, at least you know what you're looking at.
That's right. Right. So there's this is where the strategies come in and can really be helpful.
Yeah.
But right here, it just is to show that it's not income, it's a premium for accepting risk. Let's look at the covered call. Let's say you buy shares, you spend $100, you sell the 105 call, collect 3, max gain is 8. Now, before I said your maximum gain is the amount collected. So sometimes traders get fooled with this. The maximum you are earning from this call is 3, period. The reason this is 8 is you've got shares at 100 that might get sold for 105.
That's
that
right.
$5 came from the stock, not the
That's
option.
right.
Right. So that it still fits with that definition. The most you will
Remember
ever
that
make from
guy
this
that
call-
sold the stock was around a hundo and he sold the 150 call and the stock went up and he said, "Look how much money I made on the
yeah.
option strategy."
Right, because you
Dude, you
sold
sold
it
them for like 10 cents. You
Yeah.
made $50 on the stock, man. Come on.
Right, right. You would have made that even if you hadn't sold the option.
Right. Without the obligation.
Right. So your break even here would be 97, and that's because you own stock at 100, but you've got a $3 cushion underneath you. So you could afford to have it fall to 97 and just break even. And again, the story that traders say is I get paid to sell the shares at a favorable price. They're trading for 100, and I'm willing to let them go for 105, and somebody's going to pay me to do that. So I'm generating income. Not exactly. Let's take a look at it. All right, you're not paid to sell stock at a favorable price. Here's your stock at 100. You sell the 105 call. In your head, you're saying, yes, that price is higher than the current 100. That is true. But just like with the naked put, you're not going to sell it here unless what happens, Stu?
Well, listen, you guys out there that are watching this, answer that question, right? I mean, Bill put it up there, right? The only way you're going to get assigned is if the stock is higher than 105.
So now the stock
and you have an obligation to sell it at 105. So how is that a favorable price if you have to if you're getting assigned at 105 and the stock is trading at 110 or 108 or 120? Right.
Now, here's another little misperception where people say, well, okay, I might have missed a few bucks, but I'm still fine with it. But go look at CAR, right? We're just looking at that Avis, right? And we just saw, I mean, it was a $85 stock, went to 700 in a short time. And you might have sold that out of the money option for 30 cents or $1 something going, oh,
or $5.
Or $5.
Because it's so volatile
all
on
the way
to the
up. Bank. And you're going, gee, I just left $70,000 on the table.
Ooh.
Then you're not going to see that as a favorable deal.
Yeah. Now look, people might be thinking, "Oh, you guys are picking and choosing," and yeah, we do that to prove the point.
To prove the point.
So, that's why we use extreme examples to prove the point. Does that happen every day in a big general market index like the SPX?
Oh God, never.
Absolutely, right? Just go check out, what is it? The BXM, right? Go check out the BXM, right? You're going to see that over time that selling those options, you will underperform the index, right? Why? Because there's an opportunity, because there's an obligation, and there's an opportunity cost involved that most people, not all, but most people just do not want to have a conversation about. Yeah, I made money, but they don't talk about the money, the alternative money that might have been left on the table because of your obligation. They just want to talk about the $10,000 in income that they made from selling calls.
Right. So again, opposite side of the put, you get paid to sell shares at unfavorable prices. So if we look at the risk graph here, looks a lot like a naked put, doesn't it, Stu? So what's going on
Yeah.
here? We own the stock. There's our positive deltas. We sold the call. We flatten out. We've sold all of our rights above the 105 strike. We still have all of this downside risk.
And this is basic options, people.
Yeah.
Right? Just walk it through. You sell a put, you have an obligation. Obligation to do what? If it goes under, you're gonna get, if you don't, assuming you keep it, you're
Right.
gonna get assigned. What's that mean? You're gonna buy the stock. There you
will
go.
become line. You will become long. The covered call, you're long first. So here's the distinction. If you own the stock plus the obligation to sell, which is a covered call, that's exactly the same thing as saying I have cash with the obligation to buy. It's a question of when you become long the stock.
Wait,
Buy the
hold
stock
on.
today.
Hold on, man. Hold on. There's a light bulb going off. It's trying to flicker on. I see Karnak. Everybody remember Karnak? Used to be on the Carson, Johnny Carson,
Yes.
right? What's that term? Wait, it's coming. It's coming. It's on the tip of my tongue. Cash secured put.
Right.
There you go. Cash. Whose cash is it, Bill?
Right. It's yours.
It's yours, dude. Come on.
Right. Right. It's yours. And so it's a question of when you buy the stock. If you buy it today, you've got an obligation to sell. But then sometimes traders say, well, yeah, but then I got to put money out for the stock and I got to lose interest. Let me do the put. But what comes out of that equation? The interest. You're going to be compensated that you're going to receive more, all things equal, for that call than the put. It all balances out. It's really a question of when you're going to become these long
Check
deltas.
out the Black-Scholes model, people. There's a piece of it called the cost of carry.
And that will always balance. Trust me, all this stuff balances, except in traders' heads. So selling options, the max gain is known, max loss isn't, or at least is far larger than the premium. And if your best outcome is known, but your max loss isn't, you're not earning income. You are underwriting. You're acting like Geico. And again,
Which isn't a bad business, right? Geico, they do
Warren
well.
Buffett made a few bucks doing that, right?
So wait, remember that dude? I can't remember his name, and I apologize if you're watching, sir. But remember that dude that was in our Q&A or is in our Q&A? That was the insurance underwriter,
Oh,
and
yeah.
he told us that it was like 35 or 40 years he was in the business. The money that the insurance companies make
Mm-hmm.
is not from the premiums they sell.
Right.
It's that they take in. It's from the float of the money.
It's from the
that-
investment of it. Sure. Yeah.
which kind of
Absolutely.
comes back to fair value, right?
Fair value, cost to carry, all that good stuff. Yep. So again, you're underwriting. Now, but also here's another distinction. You might say, well, gee, Warren Buffett made money with that. Yeah, but they also had a massive pile of other people's money to play with. All right. And they're also spreading that risk out across the
Yeah, I
world.
was just going to say
Certainly
that it's
across
not
the US.
it's not
You're not
American Express. It's not one stop, right? It's
right. You're not
it's
saying I'm gonna
millions of customers.
right. This would be the same as saying Warren Buffett says, I'm going to insure that driver for the next 30 days.
Yeah,
Well,
yeah.
that's not, but that's what you're doing when you're selling puts. You're picking a specific stock over a specific,
And that's okay.
and that's okay. But
It's
just
okay.
understand you're not
okay.
insured. You're not. You don't have the balance sheet.
It's not free money. We're trying to drive this home, people.
Right.
It's not free money. There's an
Don't-
obligation, and things happen in the marketplace,
Right.
and that's the game that you're trying to play. That's it. That's all we're saying.
Don't think that you're an underwriter without the balance sheet. See, there's a big difference there. So, because I've heard that a lot. Oh, I want to be the underwriter. Well, then you'd better have the balance sheet to back it up. And if you don't, be very careful about doing that, saying that I'm just generating income.
Yeah, you better run for the hills
So-
when the hurricane's coming.
Yeah, oh, yeah. The 3% in our example here with the cover call, the $3 premium isn't what you made. You agreed to take on another trader's problem for $3. That's the framing that you want to say. I'm becoming an underwriter. And if that fits in your game plan and your balance sheets, no problem. But if you're doing it because it's free money, which we've seen, somebody said, oh, if you get at least 1%, I call it printing money. No, it's not. Oh, I got gas money for that. I sold these puts, got some gas money. Just keep doing it. Stu and I have a term for that strategy. We call it a matter of time. You haven't been doing it long enough. Keep doing it and you will find out why EV goes to zero the hard way.
And by the way, everyone, it's not really, it's not Bill and Stu's terminology. It's any competent, and I use that word very strongly, competent person of risk management understands that that's what's going on.
For sure.
It's only a matter of time. It's not when, it's not if, it's when.
So we just want to
It
make
will
sure
happen.
we just want to make sure that everybody understands that so that it doesn't happen to you. So let's come back to our Chalk Talk question. If you sell a covered call, did you generate income? What do y'all think? No, you accepted a liability, and that is not income. So that's all we have for you here today. Stu, this is a good one. I think this is going to hit home for a lot of people.
I hope so. I
Hopefully
really
turn
hope
that
so.
light bulb on for some people.
And Bill and I welcome you into Q&A to have further discussions about it.
Bring these questions in.
Bring it. Yeah, we're always ready to have the discussion.
Yep. So looking forward for another exciting day here in the markets. We'll see many of you on Q&A tomorrow. And with that, we'll see you next week on Coach's Corner. We'll see you then.
See ya.